Hey everyone, and welcome back to the Deep Dive. Today we're going to be talking about building passive income.
All right.
Money that works for you even while you're sleeping.
Absolutely.
And we're going to be doing it with dividend ETFs.
Very cool.
I know that might sound kind of intimidating at first.
Yeah.
But trust me, it's like building with financial Legos.
Okay.
Once you understand the pieces,
Yeah.
it's surprisingly simple and fun.
Yeah.
So if you're new to investing and the idea of earning while you sleep sounds pretty awesome, then you're in the right place.
That's right.
We're going to break down everything in plain English, and by the end of this, you'll be ready to start building your very own passive income stream.
Very exciting.
We're going to focus on 3 specific ETFs.
Right.
The JP Morgan Nasdaq Equity Premium ETF, ticker symbol, JEPQ.
Yeah.
The SPDR Portfolio High Yield Bond ETF, or SPHY.
Okay.
And the iShares Core U.S. Aggregate Bond ETF, known as AGG.
That's a great selection for anyone starting out. Each of these ETFs offers a different way to build passive income, and together they can form a really solid foundation for your portfolio.
Okay, so let's unpack these ETFs one by one. But before we do that, Can you explain what an ETF even is?
Sure.
I mean, I know it stands for exchange-traded fund, but what does that actually mean for someone who's new to this?
Imagine you're at a grocery store.
Okay.
And instead of buying individual ingredients for a recipe, you pick up a pre-made meal kit that has everything you need perfectly portioned out.
Okay.
That's kind of like an ETF.
All right.
It's a basket of stocks or bonds bundled together so you can invest in a whole bunch of companies or bonds with just one purchase.
Okay.
That gives you instant diversification, like having a variety of different ingredients in your meal,
Right.
which is super important for spreading risk and making sure you're not putting all your eggs in one basket.
I love that analogy. So instead of spending hours researching and buying individual stocks or bonds,
Yeah.
I can just buy an ETF that already has a mix of them, pre-selected by experts. That sounds way less overwhelming for a beginner like me.
Exactly. And because ETFs are traded on exchanges, just like individual stocks,
Okay.
they're easy to buy and sell. You don't need a lot of money to get started, and they're generally very cost effective.
So ETFs are like pre-made investment kits
Yeah,
that make investing simpler and more accessible.
that's a great way to put it.
Now let's get back to our 3 contenders, starting with JEPQ.
All right.
This one seems unique because it uses something called options premiums to generate income.
Yes.
Can you break that down for us?
Sure. Options premiums are like getting paid for the possibility of something happening.
Okay.
Imagine you have a rare baseball card.
Okay.
And a collector is interested in buying it, but they're not sure yet.
Okay.
They might offer you a small fee, a premium for the right to buy your card at a certain price within a set time frame.
Okay.
If they decide to buy, they get the card at the agreed upon price.
Okay.
If they don't, they lose their premium and you keep it, plus you still have your card. JEPQ essentially does this with stocks writing options contracts that generate premiums,
Okay.
which they then distribute to investors as dividends.
So it's like JEPQ is getting paid for giving others the option to buy or sell certain stocks at a specific price.
Yeah.
And even if those options aren't exercised,
Right.
JEPQ still keeps those premiums boosting its income and ultimately paying out higher dividends to investors.
You got it. And what's even more interesting is that JEPQ also holds a portfolio of stocks itself,
Okay.
aiming for price appreciation, along with those juicy options premiums.
So it's like getting paid rent on a house while also hoping its value goes up over time.
Exactly.
Double win.
Yes.
It's generating income from those premiums
Yeah,
and potentially growing in value through its stock holdings.
that's right.
Now I'm seeing that over the past year, JEPQ has had a dividend yield of 9.5%.
Yes, very impressive.
What does that really mean in terms of actual money? Can you give me an example?
Sure. Let's say you invest $10,000 in JEPQ. With a 9.5% dividend yield, you could potentially earn $950 in dividends over the year.
Okay.
That's $950 of passive income just for holding the ETF.
Wow.
Of course, yields can fluctuate, but it gives you an idea of the potential income stream.
Okay, $950 just for holding an ETF.
Yes.
I can definitely see the appeal of that.
Yeah.
All right, let's move on to our next ETF, SPHY.
Okay.
Now, this one invests in something called junk bonds.
Yes.
Could you explain why anyone would invest in something called junk?
Well, the term junk bond does sound a bit harsh, doesn't it?
It does.
They're actually just bonds issued by companies that are seen as a bit riskier.
Okay.
Think of it this way.
All right.
If you're lending money to a friend who has a stable job and a good track record of paying back debts, you might charge them a lower interest rate.
Yeah, that makes sense.
But if you're lending to a friend who's known to be a bit unreliable,
Right.
You might charge them a higher interest rate to compensate for the increased risk. That's kind of how it works with bonds.
Gotcha.
Companies that are considered riskier have to offer higher interest rates or yields to attract investors.
Okay.
These higher yielding bonds are often called junk bonds
Right.
because they carry a higher risk of default, meaning the company might not be able to pay back its debt.
So it's like getting a higher return for taking on more risk.
Yeah, exactly.
But wouldn't that make an ETF like SPHY,
Yeah.
which invests in these junk bonds, extremely risky overall?
Not necessarily. SPHY mitigates that risk through diversification.
Okay.
It holds over 1,900 different junk bonds,
Yeah.
spreading the risk across a wide range of companies and industries. Think of it like this.
Okay.
If you put all your eggs in one basket and that basket falls, you lose all your eggs.
Yeah.
But if you spread your eggs across multiple baskets, even if one falls, you still have some eggs left.
I see. So even if a few of those companies in SPHY's basket have trouble,
Yeah,
the overall impact on the ETF in my investment would be lessened.
that's right. And currently, SPHY is paying out a distribution yield of over 7%.
Okay.
That's significantly higher than what you typically get from less risky bonds.
Okay, so SPHY is all about potentially higher returns,
Yeah,
but with a bit more risk involved.
right.
And it uses diversification to help manage that risk.
Exactly.
And let's talk about AGG, our final ETF for today.
Okay, sounds good.
This one focuses on investment-grade bonds, which sound much safer than junk bonds.
Yes, they are.
Can you tell me more about that?
Absolutely. Investment-grade bonds are issued by companies or governments that are considered financially stable
Okay.
and have a lower risk of default.
Okay.
Think of them as the reliable friends who always pay you back on time.
Right.
AGG holds a wide range of these bonds, including U.S. Treasury bonds,
Okay.
which are backed by the government and considered some of the safest investments in the world.
Right.
This makes AGG a great option for those who prioritize stability and want a reliable income stream without taking on too much risk.
So if I'm new to investing and I'm looking for something that's relatively low risk and provides a steady income stream,
Yeah.
AGG might be a good fit for me.
It could be, especially if you're just starting out and building a foundation for your portfolio.
Okay.
AGG is designed to provide consistent income with minimal fluctuations,
Gotcha.
making it a great choice for those who are risk-averse or seeking a reliable source of passive income.
That makes sense. So we've got our 3 ETFs.
Yeah.
JEPQ using options premiums for potential high growth and income.
Right.
SPHY focuses on higher yield with managed risk.
Yes.
And AGG providing stability and peace of mind.
That's right.
Now, how do we actually go about buying these ETFs, and what should beginners be looking for?
Great question. There are a few key strategies you can use to identify buy-in opportunities.
Okay.
Let's start with JEPQ.
Right.
Since its income comes from options premiums, which tend to be higher when the market is more volatile,
Okay.
those volatile periods when prices are going up and down a lot can actually be good buy-in opportunities for JEPQ.
It's like buying a raincoat when it's raining. You're getting it at a discount because demand is high.
So with JEPQ, I shouldn't necessarily be scared off by market dips,
Right.
but instead see them as potential buy-in opportunities.
Exactly. Another thing to watch for is when price drops to a level where it's bounced back in the past,
Okay.
called a support level.
Right.
This could signal that it's a good time to buy. Think of it like a trampoline. The price might bounce down, but it tends to spring back up from that
Yeah.
support level.
So it's almost like JEPQ thrives on a bit of chaos in the market.
In a way, yes. The more volatility, the higher the premium can potentially collect.
Interesting. Now, what about buy-in opportunities for SPHY?
Oh,
What should I be watching for there?
with SPHY, it's helpful to pay attention to the difference in yield between high-yield bonds,
Okay.
like the ones SPHY holds, and U.S. Treasury bonds, which are considered very safe.
Right.
This difference is called the yield spread.
When that spread gets wider, it could mean that junk bonds are becoming more attractive relative to safer investments,
Okay.
creating a buy-in opportunity for SPHY.
So if investors are demanding a much higher yield on junk bonds compared to Treasury bonds,
Yes.
it could be a good time to buy SPHY.
That's right.
Kind of like when your favorite store has a big sale, you're getting more bang for your buck.
That's a great way to think about it. And another strategy is to watch for interest rate announcements from the Federal Reserve,
Okay.
which can impact bond prices.
Right.
Junk bonds, like the ones in SPHY, can be particularly sensitive to interest rate changes.
Okay.
So you might see buying opportunities after the Fed makes an announcement, especially if rates are going up.
So keep an eye on the Fed, got it.
Yeah.
Now, what about buying opportunities for AGG?
With AGG, you can apply a similar strategy watching for those Fed announcements on interest rates.
Okay.
Remember, AGG holds mostly investment-grade bonds, including U.S. Treasury bonds.
Right.
When interest rates rise, bond prices tend to fall. This means that if the Fed announces a rate hike, it could create a buy-in opportunity for AGG as those bond prices dip.
So it's kind of the opposite of what we discussed with SPHY.
Exactly.
With AGG, we're looking for buy-in opportunities when interest rates are going up, not down.
That's right. It's all about understanding how interest rates affect different types of bonds.
Right.
And using that knowledge to your advantage.
This is all starting to make sense.
Yeah.
We've covered support levels, yield spreads, and interest rate announcements.
Yes, we have.
What about using moving averages as a guide for buy-in?
Sure.
I've heard that term thrown around a lot.
Moving averages can be a helpful tool for all three ETFs.
Okay.
They're like a trend line that smooths out price fluctuations over time.
All right.
A common strategy is to look at the 50-day and 200-day moving averages.
Okay.
If an ETF's price dips below one of these averages, it could signal a potential buy-in opportunity.
Okay.
Think of it like waiting for a wave to recede before jumping in for a swim.
Okay, so with moving averages, we're essentially looking for dips below those trend lines to signal potential buying opportunities.
That's right.
So we've got a lot of strategies here, watching support levels, monitoring moving averages,
Right.
paying attention to interest rate announcements,
Yes.
and understanding yield spreads.
Uh-huh.
This might be a lot to track for someone just starting out.
Yeah, it can be a little overwhelming.
Any tips for keeping it all straight?
Well, don't worry. It's all about taking it one step at a time.
Okay.
Start by focusing on one or two of these strategies and get comfortable with them before adding more to your toolbox.
All right.
There are also plenty of resources available online and through your brokerage account that can help you track these indicators.
That's a great point. And remember, Rome wasn't built in a day.
That's true.
Start small, keep learning, and over time you'll become more and more comfortable with these concepts.
Exactly.
We've also explored various buy-in strategies to help us find those sweet spots for purchasing.
Great.
Now, how do these ETFs actually fit into a well-rounded portfolio?
Okay.
Should I put all my money in just one, or is there a better way?
Diversification is key, remember?
Right, spreading those investments across different baskets.
It's just like you wouldn't want to eat the same meal every day. You don't want to put all your investment eggs in one basket.
So it's all about creating a balanced investment meal with a mix of different ETFs to nourish my portfolio.
Exactly. Holding all three of these ETFs could help you create a really well-rounded passive income portfolio.
Right.
You have the potential for high growth and income with JEPQ,
Right.
the higher yield of SPHY,
Mm-hmm.
and the stability of AGG.
Gotcha.
It's a mix of different strategies and risk levels, which can help smooth out your returns over time.
That's a great way to think about it. I'm starting to see how these ETFs can work together to create a diversified, a potentially profitable passive income stream.
Yes.
So are you ready to move on to part 2 of this deep dive?
Absolutely. I'm excited to continue exploring the world of passive income with you and our listeners. All right, let's go.
We're in the midst of exploring dividend ETFs and how they can help you build a passive income stream. It's like having your money work for you even while you're out living your life.
Exactly. It's about putting your money to work smarter, not harder.
All right, so let's say our listener is ready to take the plunge and start building their passive income portfolio using these ETFs. What are some practical steps they can take? Where do they even begin?
Well, the first step is opening a brokerage account.
Oh,
This is like your financial command center where you'll buy and sell your ETFs.
right.
There are tons of brokerage accounts out there, from online platforms to more traditional firms. So it's really about finding one that feels right for you.
Okay.
Think of it like choosing a bank. You want one that's trustworthy, easy to use, and has the features you need.
Okay, so I need a brokerage account to actually buy and sell those ETFs. What's next?
Once you have your brokerage account set up, it's time to start digging deeper into those ETFs.
Right.
We've talked about JEPQ, SPHY, and AGG.
Right.
But remember, this is just the tip of the iceberg.
Oh, wow.
There are thousands of ETFs out there,
Thousands.
each with its own unique investment strategy and focus.
Wow. That's a lot. It's like walking into a giant library of investment options.
Exactly. It can feel overwhelming at first, but that's where research comes in.
Okay.
Use those online resources, read reviews, and compare different ETFs to see which ones align with your goals, risk tolerance, and investment timeline.
So don't just blindly jump into an ETF because it sounds cool or has a catchy ticker symbol.
It's essential to understand what you're investing in and why.
Okay.
Look at the ETF's holdings, its historical performance, and its expense ratio.
Oh.
That's the fee you pay to manage the fund.
Right.
And remember, diversification is still key.
All right, spreading those investments across different baskets. So once I've done my research and picked out a few ETFs, how do I actually buy them?
It's surprisingly simple.
Okay.
Once you're logged into your brokerage account, you'll search for the ETF's ticker symbol, like JEPQ for the JP Morgan Nasdaq Equity Premium ETF,
Okay.
and enter a buy order. You'll specify how many shares you want to buy and the price you're willing to pay.
Okay, and that's where those buying strategies we talked about earlier come in handy.
Yeah,
Watching for those support levels, yield spreads, and moving averages.
exactly. Those strategies can help you identify potentially favorable entry points, like waiting for a sale at your favorite store.
Right?
You don't have to buy at the very bottom to make a good investment, but timing can certainly play a role in maximizing your returns.
All right, so I've got my brokerage account, I've chosen my ETFs, and I've even learned some buy-in strategies. Now
What
what?
comes the fun part, watching those dividend payments roll in. Once you own those ETFs, you'll start receiving those dividends, those little rewards for being a shareholder.
Like getting paid to own something.
Exactly.
Right.
Some ETFs pay dividends monthly while others pay quarterly. But the key is that you're earning passive income without having to constantly monitor the market or make trades.
It's like getting a regular paycheck from your investments.
Yeah, that's a great way to put it.
And what can I do with those dividends? Do I just spend them, or is there a smarter strategy?
That's where the magic of compounding comes in. Instead of spending those dividends right away, you can reinvest them back into your ETFs, buying more shares.
Okay.
This allows you to buy more of those income-generating assets,
Right.
which can then generate even more dividends, creating a snowball effect.
I've heard about compound, and it's like earning interest on your interest, right?
Precisely. It's one of the most powerful tools investors have for growing wealth over time. The more you reinvest those dividends, the faster your investments can potentially grow.
So like the more money I make, the more money I can make.
It's like planting a tree. The sooner you plant it, the taller and stronger it can become over time.
So it's a long-term game. I'm not going to get rich overnight, but by consistently investing and reinvesting those dividends, I could potentially build significant wealth over time.
That's the idea. It's about creating a system that works for you, allowing your money to grow even when you're not actively managing it.
This is starting to sound less like gambling and more like a strategic game plan for building wealth.
It is. Investing, when done right, is about making informed decisions,
Right.
managing risk, and leveraging powerful tools like compounding to reach your financial goals.
Okay, we've covered a lot here. We've talked about brokerage accounts, choosing ETFs, buying strategies, and the magic of compounding. What are some final words of wisdom you'd like to leave our listeners with?
Well, the first thing I'd say is don't be afraid to start. It's easy to get caught up in the complexities of investing, but remember, even the most experienced investors were once beginners.
That's true.
Start small, keep learning, and don't be afraid to ask questions. There are so many resources available to help you along the way.
Just like learning to ride a bike.
Yeah.
You might wobble at first, but with practice and guidance, you'll eventually find your balance and ride with confidence.
Exactly. And speaking of guidance, don't be afraid to seek out the help of a financial advisor if you need it.
Okay.
They can provide personalized advice and help you create a plan that aligns with your specific goals and risk tolerance.
That's a great point. It's like having a coach in your corner, cheering you on and helping you navigate the ups and downs of the market.
And most importantly, remember that investing is a marathon, not a sprint.
Exactly. By the way, take a look at the links in the description to sign up for a brokerage account and start building your portfolio today. Plus, if you use our link, we'll both get some free stocks. Pretty cool, right? And don't forget to like and subscribe for your quest for profits.